Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp. It's great to have you with us this morning. Well, it's 2026. We're here, the new year is here, and there are economic questions here. Some of them are familiar, some of them are new. We're going to be talking about those this morning. Our Chief Economist, Gerald Cohen, will be with us. He is going to talk about his 5 economic trends for 2026, a little preview of an article of his that will be coming out next week on our website. So stay tuned for that, as well as a look at the new jobs numbers. That's right, we have new jobs numbers, something we haven't had for the last 3 briefings. So we're very excited about that. Gerald is looking at those right now, and he will be giving you his analysis straight ahead. So we're going to be here for about 30 minutes. Gerald will be on and give his presentation in 15 to 20 minutes on both the new jobs numbers, some other economic trends that he's thinking about. Then we're going to go to questions. Those are your questions. You can send those to us at any time using the Q&A function at the bottom of your screen. If you're a member of the media, please include your organization with your question so we will know to prioritize that question and get it answered. If you are with us this morning by phone, you can ask a question as well. You can email it to me at rob_knapp@kenan-flagler.unc.edu. I will be keeping a lookout for those. And we, like I said, we'll go for about 30 minutes, maybe a touch longer. We'll try to get all of your questions answered as best we can. So let's go to it. There's lots to talk about this morning. Joining us is Gerald Cohen, who is the Institute's chief economist, and he has some things to say. Gerald, good morning. It's good to see you.
Good morning, Rob. It's great to see you. Happy New Year.
To you too.
And good morning to our audience. I hope people had a wonderful holidays and looking forward to an exciting new year. So let me start by, let me get my, wow, that's amazing. There we go. Get my briefing shared and go into presentation mode, all the things that there we go. So let me start by, I'm going to give you an overview of the 5 trends, and then we'll talk about the employment report, and then I'll go back to kind of the 5 trends and talk about, give you a bit more detail and what my thought process is. And then again, it's a bit of a taste and encourage you all to read the report that'll be published, I think, on this coming Tuesday. So the 5 trends, and I historically ask them as questions, are one is how miserable are we? And I'm going to talk about the misery index, which is the combination of unemployment and inflation. The second is AI exacerbating uncertainty? There is lots of uncertainty in the economy, and I think AI has both short and long term. There's a lot of uncertainty about AI, both in the short term and the long term. Question 3 is what the Fed should do in given these scenarios, and I'm going to kind of give you 4 different scenarios related to the misery index and AI. Number 4 is what challenges do local economies face? We're about to publish, or we're going to publish our American Growth Project forecasts in a few weeks. And so I'll give you a little preview of that. And then finally, related to our grand challenge, how is the worker firm compact evolving? Which I'll just say that's the title of our grand challenge, and so that's something that we will be discussing over the course of the year. So on to the employment report. It was a bit weaker than expected, and the challenge is that the previous months were also revised down meaningfully. So that's originally when I had prepared for this, I had said, well, I think the labor market is slowing but doing okay, but those downward revisions are actually quite worrying to me, and so I'm not saying we're in a recession, but but I'm worried. I'm worried, and this report makes me more worried. So I'll show you the numbers. 50,000 jobs were created, a bit less than the expected of 65, but those downward revisions were had a net of 76,000. So the 3-month moving average with that big decline in October, which was led by basically as a result of government jobs, um, uh, gave us a big decline in October. And so the 3-month average is negative, but that's not what worries me. What worries me is if you look at the private sector, um, the private sector in the month of October when 174,000 jobs were lost, 173,000 jobs were lost. There was all of it was all of the loss was government jobs, but there was a gain of just 1,000 jobs in the private sector. And so we're having job growth, a very modest job growth over the last 6 months in the private sector. They were up 34,000 in the month and sorry, 37,000 in the month, and the 3-month average is 29,000. You can see that private sector job growth has slowed meaningfully. If we stay here, we'll be fine. The question is, will we stay here? And again, those downward revisions to previous months said, that things were pretty weak in the fall. So that is my concern. In total, 584,000 jobs were created, but as this chart illustrates, it was basically two sectors that created all the jobs, and then the other sectors were actually job losers on net. So 713,000, the green line came from healthcare, 188,000, the orange line came from leisure and hospitality, and then the rest, government was down, and all other sectors in total were down. I mean, there were some that were, up a little bit, and some that were down a bit, but in total, all other sectors. Now, I mentioned this a few briefings ago, and I just want to say that I just want to remind people that healthcare generally, we've for 40 years, we've basically seen almost no months. I mean, there might have been one or two when you've seen job losses in healthcare. So healthcare has been a consistent job creator. And when you get a recession, you just have all the other ones that are pulling down jobs, offsetting healthcare. And so in some respects, we're seeing a little bit of that now. Now, government is a result of the cuts related to DOGE, and it doesn't. I would hope that we don't continue to get those job cuts. So going forward, and in this month we did get job gains in government. So maybe that negative will turn into a positive or zero again. But the question is the other parts of the private sector. Are we gonna see job growth? Um, Purchasing power is still growing. That's meaning that wages are growing faster than inflation, but the gap has narrowed as this chart illustrates. Wages are up 3.8% on the year. Inflation was up 2.7% through November. We'll get the December CPI in a week or so. And so we'll see how that goes. And there is concern that there's going to be a pickup in inflation, that the November number was kind of was as a result of the government shutdown. You didn't get a good price measures between October and November. And there's some measurement questions. So we'll see what happens, but we're still having purchasing power is, wages are growing faster than inflation, but that gap is narrowing, and that has implications for consumer spending. And if you're not getting a lot of job creation, then you're not having that push to consumer spending as well. So job creation spurs consumer spending, purchasing power spurs growth, spurs consumer spending, and so we're seeing both of those weaken. The unemployment rate edged down to 4.4%. It's still low by historical standards. We're up 1 percentage point from the low that we've seen. And historically, when you do see rises in the unemployment rate of this magnitude, we tend to continue to rise and go into recession. But I acknowledge that this cycle has been different because of COVID. Um, so um, the other challenge is that, and this is a very weird phenomenon, is that the labor force has basically been growing very quickly. Job creation, job growth has been slow, and labor force has been slow, which is why the unemployment rate hasn't gone up by more. In normally, when you get this slowdown in job creation, you see the unemployment rate rising even more, but effectively because the unemployment because the labor force has been slowing and I think I attribute a lot of that to immigration policies. You are seeing less. You're kind of having this offset of the unemployment rate is just ticking up a little bit because month to month it was down, but in general it has this upward trend because because job growth is slow, but it's not ticked up as much because of the growth because labor force has been slow. I apologize if that, let me try to say that succinctly. The reason why the unemployment rate has not gone up by more is because the labor force has grown relatively slowly. Going back to our five trends. So, how miserable are we? So, the misery index is a combination of the unemployment rate and the inflation rate. It's a very simple index. It's not meant to, talk about how individual households are doing. It's just a very simple way of saying, in general, how good or bad is the economy. And what we've seen is we've seen this after the inflation spike, kind of post-COVID, where the unemployment rate was low, but inflation had ticked up. What we're seeing is kind of inflation has come down, but is stabilized at this kind of troubling level. It's not, or maybe troubling is too strong a word, but it's kind of stubbornly high in the 2.73-ish range. The Fed wants it at 2. And the unemployment rate, as I mentioned in the last slide, has been increasing. So you're starting to see the misery index tick up. It's nowhere near the bad old days of the 1970s and early 80s when it was developed. But it is worrying, and households are especially concerned about inflation given the experience that we had in the post-COVID period. So households are very sensitive to inflation, and the fact that inflation, the gains in inflation or the inflation rate has kind of stalled at this 2.73% range, um, is troubling to households. And the question going forward for 2026 for economists, for the Fed, for policymakers, for business people is, will the unemployment rate stabilize? Will we have healthy enough job growth to offset gains in the labor force? Will inflation head lower? And so the Fed has to stop worrying about that. And I'll talk about the Fed in a bit. One of the reasons why we've seen the misery index hasn't gone up more is because we've had what economists call this labor hoarding, where firms aren't hiring a lot, and you can see the blue line, the higher rate has kind of come down a bit, or has come down from post-COVID periods, and for the data that we have, it's quite low. But we're not seeing a lot of layoffs, and you see that in the jobless claims. You see it in a lot of measures. I mean, you've had layoffs related to government workers and you had some layoff announcements, but in general, the total number of layoffs has not been that high. So that's called labor hoarding. And the question is, if the economy weakens further or businesses start getting worried, will they stop hoarding labor and start shedding it? And the reason they've been hoarding labor makes sense because it was so hard to find people to fill jobs in the kind of post-pandemic period. And so it makes sense for for businesses to say, I'm going to hold on. I'm not going to let people go because I found these people, I've trained these people. But the question is how long that can be the case. On the inflation front, what we've seen is a tale of two sectors. The goods sector, inflation has picked up meaningfully as a result of tariffs. In the service sector, inflation has come down as a result of slower housing inflation. These have effectively offset themselves. I mean, And again, so the question is, will housing inflation continue to slow? Will goods inflation reverse? Or have firms been holding the line on tariffs, and maybe at some point they're going to say, because of, again, the revenue pressures, we're going to have to raise prices even more. So that's a key question for 2026. Trend two is AI. And so here I've depicted the impact of IT hardware and software investment, which is basically where you're going to see the impact of AI investment um, over the course of the last 40 years. And in 2025, we estimate, we only have data through Q3, that IT hardware and software accounted for about 20% of GDP growth in 2025. Um, that is not unprecedented. And in fact, in the kind of period in the late 90s, you saw very high levels of IT investment, or IT investment made a significant impact, 20% or larger on GDP growth. Now, overall, GDP growth was higher because productivity was higher, and I'm going to get to that momentarily, and also because labor force growth was stronger because of demographics and immigration policies. And so but the question is, is this IT investment going to continue? Are you bullish on long-term investment as a result of AI, or is this are we nearing the kind of 99 2000 dot-com bubble, where after which you saw a significant slowdown in IT investment? So that's the kind of cyclical impact of IT. By the way, in the report I talk about data centers. They've been growing quickly, but the impact is really small. And if I put it on that data centers and power on this chart, you wouldn't even see the lines. They're really, really small impact. It's 0.05 percentage points of GDP versus zero point 0.4 percentage points for IT hardware and software. So I mentioned productivity, my favorite topic. The key question for AI is it going to cause a productivity revival? And we've had very weak productivity for the last 20 years. You're starting to see some pickup. People have called me after yesterday's productivity report, and I said, well, it's nice to see the productivity gains, but the problem is that was a result of weak labor force growth, or weak hours growth, and strong GDP. You want to see strong productivity when we have strong workforce growth, or hours growth. So the key question about AI is, will it cause a revival? How long is it going to take? Because usually this investment has the J curve of change, where you first see a negative impact as it takes time and money to invest in that technology, and then you see the productivity revival. And so that's, again, look out for the report for more discussion of that. Um, the other question is, will AI cause mass unemployment? And is the weakness in hiring that you're seeing for new grads? And it's actually, you can see in this chart that the unemployment rate, it's not just new grads, but it's actually all folks with bachelor's degrees, where even older, more experienced folks have a higher unemployment rate than high school graduates, which is a very interesting phenomenon. Normally, now, sorry, the unemployment rate for high school graduates is double that of folks with bachelors, but the unemployment rate has not increased for those folks, for just high school graduates, while the unemployment rate for bachelor's degrees and higher has increased. So I just want to be clear. It's the rate of change, not the level, that I'm talking about. That you're seeing new hires, and also all folks with bachelor's degrees having a harder time, or their unemployment rate has gone up, and they're having a harder time. And the question is, how much of that is AI, or how much of that is cyclical? Um, Bringing these all together, the question is, what is the Fed to do? And this chart depicts two estimates of the neutral interest rate, one by the New York Fed, one by the Federal Reserve Board of Governors. And then the blue line, that's the orange and the green, and then the blue line is where the inflation adjusted Fed funds rate. And you can see we're kind of at or below the neutral interest rate. The question about policy relates, and we have these four scenarios that we've developed, two cyclical, two structural. Um, where will inflation and unemployment go? The cyclical questions. And that doesn't really affect neutral. And then B, what about if AI raises productivity? And that does affect neutral. So let me go through them quickly. Or first, I should say the view on the cyclical is not unanimous. This is the famous dot plot from the Fed. The Fed cut rates right here to between 3.5 and 3 3/4. This was the Federal Reserve FOMC member estimates of where the funds rate would end the year. It ended right here where most of these dots are. But six people thought that the Fed should not cut rates. Now, there were two dissents, but there were four, or there were potential, likely four other what you'll say soft dissents on raising rate, on not cutting rates. There was one dissent right here on that the Fed should cut rates more aggressively. But this view, and you can see going forward, there's a very high dispersion of views on what the Fed should do next year. Some people say shouldn't have cut rates and they should actually raise if they should raise rates. Some people say they should cut rates meaningfully. So the Fed at the moment is saying we're worried more about the labor market than inflation. That's what the consensus is, but that view is by no means unanimous. And what happens going forward, the Fed is not going to change. Well, they're very data dependent. And so what happens this year will be very dependent on the inflation unemployment nexus. And on the inflation front, the concern is that this stubbornly high inflation stays and inflation expectations rise. And again, thinking about the misery index during this period of misery in the late 70s, early 80s, you saw high unemployment and high inflation, and very high inflation expectations. And that caused the Fed to have to be really aggressive in their rate hikes to get people to realize that no, we're not going to let inflation stay at this very high level. And that caused a lot of misery. And so the question is, if the unemployment rate or if the weakness in the labor market continues, inflation is likely to come down. But if it doesn't, or if inflation stays stubbornly high, the Fed might not cut rates and might have to raise rates to fight that. The flip side is related to AI. AI could lead to some, what I'll say, counterintuitive monetary policy. If AI spurs that productivity growth that we see, neutral interest rates actually would have to increase. And that's because the return on capital will be higher because of the productivity. And so you could see this phenomenon where the Fed could be actually raising rates into this environment. And you saw that here in the 90s, where the Fed kept inflation adjusted rates quite high during that period of very strong productivity growth. Alternatively, if AI spurs mass unemployment, the Fed can't lean into that, but has to kind of has to accommodate the high unemployment rate, because if they cut rates, that's not going to affect structural unemployment as a result of AI. So they could be in a tough spot, not likely this year, but in going forward, the impact of AI could lead to challenges for the Fed. It would be positive they might have to raise rates because of the high return on capital and high growth in the economy, but it could be negative and they'd have to keep rates high if the structural unemployment rate. And you can see in the 70s and 80s, you saw an increase in the structural unemployment rate, and the Fed couldn't cut rates, or cutting rates in the face of that is problematic. Lastly, I'll just mention our to keep your eyes out for our American Growth Project. We forecast we measure and forecast the economic activity for the 150 largest, what we call extended metro areas. We will be putting out a forecast for 2026 as well as estimates for 2024 and 25. Those numbers are not released. The latest government data on GDP growth on a local level comes from 2023. And going forward, um, the government is going to stop releasing data on metro levels in the 2024 release. So 2024 and going forward, you're only going to have county level GDP from the government, but we're here to fill that gap because we will continue to create our EMA level GDP growth. And I'll say, just to preview what I'm writing, what I wrote in the five trends is the impact of AI on some of these fast growing areas, um, which also have high tech, a lot of high tech exposure is something to keep your eyes out for. So I know I've gone way too long. I apologize, but hopefully we have some questions from the audience and people will indulge me. So thank you.
That is okay, Gerald. That's why we don't do 15 trends instead of five trends. So it all works out in the end. Yeah, folks, questions. If you have them, go ahead and submit them now. We have room for a few. You can do that with the question and answer function at the bottom of your screen. I see a couple popping in now, so we'll go straight to those. If you are with us by phone, you can submit them to me by email, rob_knapp@, kenan-flagler.unc.edu. First question from Brent Lane. What does monthly job growth need to be to simply meet workforce and democratic changes? I'm not sure what the last part means, although I will say that democratic is lowercase d. So, but we have workforce changes to talk about too. So,
I, I'm going to read that as demographic changes. I mean, the issue going forward with given and the CBO actually just lowered its population estimates for the long term and saying that the population is going to, I think, start to shrink in 2030. So going forward, because of demographic and immigration policy, we are likely to have quite weak labor force growth. And so that means that, historically people have that's why, when I said, well, this data makes me nervous, but the fact that the private sector is growing at roughly, 25, 30,000 per month, that may be the only that there may be the job creation that we're going to get, given demographic factors. But there's been this term called the stall speed where people say, well, at some point we're too close to zero, and we'll start to see if you're at 30, you could be at minus 30, and that's true. But will firms say, well, or people say, well, there's not that much job creation, so I'm not going to spend money, and then firms will say, well, then I'm not going to hire people. And so this concept of a stall speed, if it exists, is harder when you have the demographics of that we currently have. So I would say somewhere in the 50,000 range for job creation at the moment. Um, and that's about what we should get based on demographics. It probably maybe might be lower given immigration policies.
okay, thanks. And Brent confirms demographics. So excellent, excellent deduction there on your part. He follows up, is there empirical evidence for expectations of AI-driven productivity gains, or is it just speculation?
I mean, I have colleagues that are trying to get data on we're not going to, at this point, it's hard to see in the data. I mean, there's just so much volatility from quarter to quarter in productivity. So I don't think we've seen enough data on a macro level to say whether, the pickup, it's a little bit of a pickup that we've seen over the last year. And again, I don't want to speak to a particular quarter, is the result of AI or just a result of other factors. I have colleagues that are working on it on a micro level. So Brent, if you have firm level data that you want to share with us, we would love to see if you're seeing an impact of AI. And that's really how you're going to see it right now. Um, but on a macro level, I think you just need to see more quarters. And the way I would put it, I think I said this briefly. If we have decent labor force growth or labor force growth on par with demographic factors and strong productivity growth, that's a positive. Then that's, for consistently for a few quarters, then I think there's something there.
Okay. This one from Chris Faulkner McDonough, and Happy New Year to you, also, Chris. Question on productivity. Higher productivity growth in the 1990s saw lower inflation and higher wage growth. That isn't happening now. What sectors should we look to as a signal that the productivity benefits are spreading? Will inflation come down first or wages pick up?
So great question, Chris. And I addressed a little bit of this in five trends. It's hard to do it in the more than 15 minutes that I had planned to speak. Normally when you do have high productivity growth, you have favorable inflation. And as you said, because productivity is growing, wages can grow without causing inflation. So you'll and the question is right now, I think inflation is being more driven by the trends in inflation are being driven by tariffs and not AI, and then housing, which it would be awesome if AI could crack housing, but housing is a pretty inefficient production of housing is quite inefficient. Still a lot of people hammering nails or using nail guns. Um, um, so uh, so where we generally have seen a lot of the productivity gains are in combination of goods where it just mechanization makes goods production cheaper and cheaper. And that's why if you look back at that chart, you'll see inflation adjusted um, good or quality adjusted goods prices over the last 25 years have basically been flat to down. So you would expect to see it there, but then also in service sector in places like airline reservations and inventory management and things like that. And a big one is healthcare, as can AI. That's one of our, there's a lot of job creation in healthcare because it's very, it's a very people oriented. I'm not saying that's going to go away, but the question is, could AI help and make healthcare even more efficient, which it needs to be, and we need to, healthcare is healthcare is the biggest kind of cost factor for a lot of households, and meaning or a big factor driving inflation, and so it would be great if we could see that there.
Okay, very good. One more and we're out of here. This is from Dan Barkin at NC Business, who asked the federal workforce dropped by around 11% in 2025, according to today's data. I assume these numbers exclude active duty military, and this is just civilian employees. Can you recall any similar size reduction in the federal workforce in recent history?
It's a good question, Dan. Yes, the I believe that those federal, well, actually, I'd want to check that. Does it include military? I should know that answer, and I don't. I know when the labor force numbers are civilian, so the unemployment rate and the employment numbers that come
Hmm.
from the household survey are civilian. But the payroll numbers, I need to double check. My inclination to say they don't include military, but I have something in the back of my head that says it does. So I'd wanna look at the data and let me look at the data and I'll get back to you, Dan, is the best answer I can give you.
Okay, there we go. Oh, wait a minute. I got one more.
Oh, I have a colleague who
Um,
somebody is saying does not include military. So there you go. The answer is it is civilian. So my colleagues are chiming in. So the answer is it is civilian and does not include military. And thank you to the audience, to my colleagues, my crack colleagues who are messaging me. I need to look and see whether federal government has ever been cut by this much. I will say that in 2008, you saw significant cuts to state and local governments as a result of budget constraints because they had balanced budgets. And that was actually one of the lessons that we learned from that period that you should, that the federal government should try to offset that. So the 2008 Great Recession, as it was known, was exacerbated by state and local government cuts because of budget constraints. So, but I have to look. And so we've seen meaningful cuts in total government jobs during that period. I'd have to look whether it's happened to that extent on a on a federal level, excluding kind of military drawdowns that I think you're asking about, Dan, that happened during the kind of post in the 90s. Um, so I'll get back to you on that, Dan, but thank you.
Okay, the crowdsourcing era of the briefing has begun. Thank you very much, Gerald, both for your analysis of the welcome return of the job numbers this morning, and also your five trends piece. I got to spend a little time with that piece yesterday. I hope everybody will spend some time with it next week. And you're correct, we will have that up for folks to read on Tuesday, so they can keep an eye out for that. So thank you, Gerald. Thank you to the audience. As always, we appreciate your questions, sometimes your answers, and your insight. It's part of what makes this thing fun. So thank you. So for the media in the audience, if you want to continue the conversation with Gerald or with any of our experts, please let me know. We'd be happy to talk about any of the issues that were addressed this morning or any of the other things that we deal with in the economic world. Please reach out to me at rob_knapp@kenan-flagler.unc.edu, and we will get to work on that. For everybody in the audience, we hope that you'll visit our website at kenaninstitute.unc.edu. We have a lot going on in January. We've just told you about 5 trends, which will be up next week. In addition to that, we have economic outlook reports for 2026 associated with our American Growth Project and with our collaboration with Fifth Third Bank, which is empowering American cities. So that's something to keep an eye out for. And in January, we will also officially launch our Grand Challenge for 2026. That's something that we'll keep building on throughout the year with written pieces, with videos, with experts for both inside the organization, outside the organization. It's a big deal. We hope you'll be involved from the beginning. It's always an interesting exercise, and I promise you it will be again this year. So lots to look forward to in 2026. The next thing to look forward to in terms of briefing is February 6th. We hope you will be here with us for that. We'll have more to talk about then. But for now, thanks for joining us and enjoy your Friday.
Happy New Year, everybody. Thank you. Oh, and I should note, thanks to the team, Cody, Kyle, Dingwan, for making this briefing happen. They do all this work behind the scenes.
Thanks.